Hey everybody, welcome to the morning market briefing Thursday, August 18th, 2022. Quick pulse on the market. A lot of green, but it's not real robust. Dow futures up 11 basis points, S&P up 18 basis points, NASDAQ up 27 basis points. Gold's up a little, silver's up a little. Oil quietly kind of trickling up back closer to that $90 a barrel for crude. So that's kind of where we stand. Interesting commentary yesterday, Ben, from the Fed. How would you kind of digest this in terms of where they've been? I mean, I continue to be maybe a little bit more on Tom's page. I know we had some chat on this internally yesterday in terms of what I expect from them next, but commentary is more dovish. I certainly felt.
Yeah, I definitely agree. It's nice Tom's not here today, so he's not going to disagree with me, at least today. But I thought it was a little bit dovish relative to expectations. Again, this is the meeting that happened in mid-July. So since that time, the market's rallied, mortgage rates have come down, home prices have kind of stabilized a little bit. And so I'd be interested to see what the Fed says now. In the period in between when they had the meeting and when the minutes were released yesterday, we had a better than expected, meaning lower inflation print. But then we also had more jobs created. So two countervailing forces there working for and against Fed hawkishness. But I did think it was a little bit dovish. There were a couple reasons for that. There was one quote that said many at the Federal Reserve saw a risk that the Fed could tighten more than necessary. And what they're basically doing right now is they want to slow down the pace of rate increases because they know that their policy acts on a lag and they want to begin to see the impact of what that policy is doing. They believe that they're seeing some impact now, but the bulk of the impact, as we said on this call, won't be felt for a period of time, probably 6 to 18 months. And thankfully, the Fed actually does appreciate that, which is good. And I think that that's why the Fed minutes are being dovish. Now, does that mean that we're not going to do 75 basis points? I don't think that's, I think that the future, as Tom would say, is written in pencil. And, you know, whatever happens with the inflation print and the employment print here in the month of August will kind of dictate what the Fed ends up doing. So I don't really think it changes where we are today. I do think it sheds a little bit more color on the nature of the Federal Reserve itself and the bifurcation that is in the Fed. I think that there was a thinking that everyone's on the same page of the Fed, and that's not the case. There are some people who want to go significantly faster and some people want to go slower. I think what we hear from Powell is that he would probably rather do more than less, but that's how he would go. And he does not necessarily represent the entirety of the committee.
Yeah, he doesn't. And that's where, I mean, we talked about this in our investment committee meeting on Tuesday. I continue to feel like the Fed is ultimately a committee of people with different viewpoints, and it's ultimately somewhat reactive. They've not done a great job of being proactive or predicting actual economic outputs. It's quite laughable, their expectations for 2022 GDP, what they were at the onset of the year, their expectations for inflation, totally out of whack. I continue to think that they are probably going to do more as opposed to less until they've gone too far. That's kind of my expectation. And the gone too far thing, it's going to take some time to really know what that impact is. A lot of people are pointing to the employment picture, and even today, economic data coming through just a couple minutes ago, the expectation was for initial jobless claims for this week to be at 264,000. The last reading was 262,000. We came in light, came in at 250,000. So pretty favorable data still, which I would take to mean another reason not to slow down what the Fed's doing.
If anything, go faster, because what the Fed did say yesterday is that they did expect unemployment rate to move up in the back half of the year. And readings like we just saw today with the initial jobless claims actually beginning to level off. We talked about that 4-week moving average. That 4-week moving average is still going up, but not by nearly as much. If we see some leveling off on those jobless claims, we may not have that unemployment rate increase that the Fed expects. And really, if you talk to them without cameras around and without news media and off the record, they would say they need the unemployment rate to increase in order to solve inflation, because at 3.5% unemployment, you're going to continue to have that wage pressure. And that's what concerns the Fed, because you have more wage pressure, you create more cost push inflation, you create more pull inflation as well.
On the earnings side, we did hear from a couple companies, perhaps most notably Cisco, as well as Kohl's. Very, very different outlooks from both of these companies. Cisco up more than 5% on their earnings, showing signs of good demand. Lots of spending coming in the form of network equipment, which, if we are in a true recession, perhaps this suggests that we're still in the very, very early innings of that, as companies are still experiencing pretty hefty IT outlays. They do continue to expect supply to be a challenge through the remainder of this year and into fiscal year 23. Ben, how would you assess kind of Cisco's performance?
Yeah, so this is a big one because the fiscal year ends in July. So this is where they provide guidance for a whole new year, which is kind of feast or famine. And recently with Cisco, they've tended to be a little bit more conservative, and so it tends to be a little bit more famine. This is a company that generates a lot of cash flow, that has tremendous market share, but is seen by some analysts to be structurally challenged because there are more companies coming in doing what they call software-defined networking. Anyway, it basically amounts to Cisco's doing this big business transformation. So some of this is unique to Cisco, but it is a broad commentary on the overall state of the market. And that is commercial spending. So businesses 100 people or less continues to be pretty strong. There has been a little bit of a push out on the enterprise side, very large businesses, but the web scale companies continue to have to build out data centers. That needs networking equipment. The service providers, the telecom carriers continue to build out their networks. And that's really providing a nice backdrop for Cisco. And so when they provided guidance for the coming year, they provided guidance saying that they're going to ship as much as they can for the entire year, and that they're not going to be able to meet the demand. So for the next 12 months, that's what Cisco's plan is. They really said that they have extremely strong confidence about it based on their backlog and based on the deals that they have in the pipeline, that they feel extremely good about where they are in their guidance. And it's really just going to be a matter of supply if they can get the components. They're seeing some softening on the freight and logistics cost side. They think that might have some improvement on the cost inflation, but in terms of component costs, they're not expecting any decline in chip prices. So that's where Cisco is. I thought it was an extremely good quarter. I thought that the commentary was very, very good. You had about a 6 to 9 month period over the last period where Cisco just kind of wandered in the wilderness a little bit. They were dealing with a bunch of supply chain disruptions because of the China COVID lockdowns. And I think that Cisco may be primed to actually realize that potential that we saw 9 months ago. And I would not be surprised to see it creep up in terms of allocation within your portfolio if you're a client. And we'll be continuing to be doing more work on this, but it was a good quarter, and I think they're run by an exceptional management team.
Yeah, they've done a good job. And I think one thing you touched on just briefly, that's probably massively under discussed on this show and in any kind of financial media, is really the impact of, the overall economy, where we are, trying to figure out what's happening next as it relates to kind of those smaller and mid-sized businesses. I think it's very easy to look at massive layoffs and hiring freezes at big corporations and see what probably could be discerned as just kind of corporate waste, repetitive job functions, a lot of people doing the same things, a lot of people doing things that may not truly be essential. But I do think some of those smaller, even up to 100-person type companies, 200 people, I do think some of those have experienced relatively good fortune over the last several years, but have also been in a position where they've still had to think more intelligently about their hiring and really identify, is this a need or is it a luxury to have this person? And some of those companies may be a little bit more insulated for a little bit longer. And I think that's probably going to benefit companies like Cisco that have a more diverse customer base.
And I think you have the technology imperative too. You need a network that works. You're dealing with a lot more data coming in and out. I mean, even just at our firm,
Yeah.
we've continued to upgrade our switches and routers over time. And a lot of that now is outsourced to professional IT departments. That's what we do. And they consult and give us recommendations on what we need to add to our IT network. And I think that as you get that professionalism, you see the big growth in the commercial side of the business for Cisco.
Yeah, and I think, I mean, 2 weeks from today, we've got a new portfolio manager joining the team. At a high level on economic data, you could look at that and say, hey, that's one more employed person, which is true. That's not incorrect. On kind of that secondary level, we're ordering computer equipment, monitors, laptops, getting them set up on all the technology that it needs. We have to have that stuff to keep it going. And I think that can benefit Cisco if there are pockets in which hiring kind of continues and upgrades continue. Kohl's, on the other hand, pretty bleak picture. This is a company that's been struggling for quite a while. There were hopes and expectations potentially for some kind of big corporate action to take place, maybe to be bought, maybe to be taken private. They've kind of mothballed that. Massive cuts on their expectations and their forecast. How's that look been?
Yeah, I think they actually had a couple bidders at $55 for the stock. And then they ended up saying, no, we won't take that. We were hoping for more. Really, what they were hoping is they were hoping for a bidder who would actually be able to buy the company, because the company that was looking to buy Kohl's was very small. And I don't think the deal would have worked. I don't think they would have lined up the financing. So now the stock's $30. And they just reduced their guidance substantially. And this is why you have to be careful of the value traps. The company had previously guided for earnings of about $6.60 a share. So for a $30 stock, you say, man, that's really attractive. That's trading at 5 times earnings. Classic Benjamin Graham type investing would want to buy that. But you got to be careful. You got to know what the earnings are going to be, because they just revised that $6.60 guidance down to $3. Over a 50% haircut on their profit outlook for the year. Estimates had been coming down from the Wall Street. And now you got a company that doesn't trade at 5 times earnings anymore. It trades at 10 times earnings, and it's structurally disadvantaged. And maybe it's even more expensive today than it was yesterday. Even though the stock price is down 8%. I think that they're making some strategic missteps. They said that they're firmly committed to the current dividend. They just approved a $500 billion accelerated share buyback. You have to get your own house in order first before you start buying back stock, in my opinion. Don't buy back stock if you're going to keep missing estimates and your stock's going to keep going down. You want to buy your stock before your stock goes up. But so many of these management teams, because their compensation is based off of their stock price, they do these accelerated share repurchases in order to keep their stock price up. And it just impairs the balance sheet even further and puts them in an even worse spot. So I think Kohl's, just on that alone, is making some missteps. Their commentary said that our Q2 results reflect a middle income customer that has become more cost conscious and is feeling greater pressure on their budget. We're seeing customers make fewer shopping trips, spend less per transaction, and shift toward our value oriented private brands. So basically, they're just spending less. And Kohl's needs to figure out a way to attract that customer and get them to spend more. And, I think they're pleading the fifth on this one. They're blaming the macro environment. They're not really demonstrating exactly what they're doing to address it. They're just saying it's macro and we're going to be buying back stock. And I don't know if that's the best strategy.
Yeah, they basically shelved any attempt at really reinventing themselves and recreating and figuring out a way to actually address the concern. And really, they're just focused so much on, kind of just this financial engineering. Let's keep the dividend. Let's buy back some shares. It's really one of those. You hear all kinds of trite sayings about investing, but this is a perfect example of, although you may be of the mind that good things happen to cheap stocks, which is a very common saying. We always have to remind ourselves that stocks are cheap for a reason most of the time. This would be a very different scenario if their earnings guidance was affirmed and they rolled out a really impressive strategic initiative that made you say, hey, they've actually got a path forward with this. If that were the case, one, the stock would probably not be down 9% pre-market, but two, even if it were up a little bit, it might be worth revisiting and reevaluating. But the stock's cheap. It's less cheap on a multiples basis now, even though the numbers look significantly worse. It's just kind of one of those that you've got to be mindful of what's going on from a narrative position. Certainly a big part of it's the macro side, but a lot of it is just the operational inefficiency of a company that's down 45% over the last 12 months. We're going to wrap it up there. We'll be back tomorrow morning at 8:30. Hope you guys have a great day. Talk to you soon.